We go to chapter 22, economic growth and GDP slash GNI. So let's talk about economic growth. Basically, we talked about it before now. It means the output of the country is increasing. So if the output of the country is increasing, it's just by saying we need to measure it. So to measure our economic growth, to measure the output, we have to measure our national income. You get the point here. There's economic growth, which means output in the economy or output within the economy is increasing. But these are just things we say. We need statistics. We need to be sure about what we are talking about. So how are we going to be sure? We need to measure our economic performance, which we talked about before now. So one of the methods of measurement is through the national income. So how do we measure our national income? Yeah, I wrote. The national income measures the size of the economy. So how big or small your economy is, we can get to know through the national income, the measurement of the national income. So the key measures of national income is what? The GDP, which is the total value of what we get through our PPC. That's GDP. So I'm going to give you the formula for GDP anyway. So what is GDP? I said GDP is measured. Okay. GDP is the total market value of all goods and services produced over a period of time, basically a year. So the value of all the goods and services that are produced domestically is our GDP. But we have to remember that this is what is produced in Libya, but we have some Libyans abroad, yes or no? So these Libyans abroad, they are doing some things too. They are producing goods, they are investing. So we have to calculate whatever they do, also with part of our GDP. Then that takes us more than what GDP is. Then we're talking about GNP or GNI. But before we go into this,
how can you measure Libyan abroad's GDP with the country?
Yeah, we can measure it through their wages, through their interest, through their dividends.
Okay, let's say you're Nigerian and you're in Libya, right? Okay, does your income get counted with Nigeria's?
Definitely, because I transferred.
What if you didn't?
So what?
What if you lived here, you were a citizen?
No. In as much as I have investments at home, in as much as I send money home, whatever money that goes into my country is accountable for through the banking system. So no money comes into Libya or outside of Libya without being noted. If it happens, then it becomes money laundering. So that's where the case of money laundering comes in. When you are illegally transferring money abroad, in or out. Because whatever money that comes into the country must be accountable for. That is the only way we can have values of what we have produced and values for what we have imported. Do I answer your question? Great. So GDP is measured as market prices. This implies that it considers the value of indirect taxes. So when we talk about GDP, because we're talking about the product of this country, the output of this country, that means domestically. So we have to think about the indirect taxes, which is taxes on expenditure or consumption. So the GDP of this country, if we're measuring it, is always high. Why is it always high? It's always high because we have added up indirect taxes to it. Do you get it? So GDP is high. Why is it high? It's high because indirect taxes is added to it. I think the point is clear. Do you have any question up to now? So we move on. So we have other measures of national income. We have the gross value added, which is the GVA, at basic price. So I got GDP for GVA it is GDP minus indirect taxes plus subsidies. Get the point. Our gross value added, GVA, is GDP, that's the domestic product, the value of our domestic products in terms of goods and services, minus taxes, which is indirect taxes, which is part of our GDP, which we mentioned before, plus subsidies on goods. This is what government will give to us.
Mr.
Yes, please.
So they ask us to calculate the GVA and...
Yeah, they might in the exams. So GVA is GDP minus indirect taxes plus subsidies. So that is GVA. But what brings about the basic price that we're talking about? There's always an adjustment. Most of the time we are taxpayers, right? We pay taxes. Because we pay taxes, government also put into consideration whenever they are giving subsidy. They want us to know that, oh, the taxes you pay is not just going into our pocket. We are using it for certain things. And if there's a time for us to adjust, to make adjustments, to make prices to fall, we will do. So that's why we have indirect taxes minus subsidies. This is the basic price adjustment. There's GDP minus basic price adjustment is GVA. Get the calculation. GVA is GDP minus basic price adjustment. And what brings about basic price adjustment? The indirect taxes we pay and the subsidies of government. So we know that, based on what I wrote here, we know that we receive subsidy from government. Then we have to adjust, we have to make analysis on it. Oh, I'm paying taxes. Government is subsidizing. What is the difference between the taxes I'm paying and what government is subsidizing? That's what we call basic price adjustment. Do you get it? There's basic price adjustment.
Can you repeat it?
Yeah, I'm going to repeat it. For GVA, it is GDP minus basic price adjustment. What is basic price adjustment? Basic price adjustment is indirect taxes minus subsidies. So it shows us the difference between what we pay in terms of consumption and what government is giving to us in terms of what we consume. You know, subsidy is a financial help from government, but we're not getting it directly. We get it through government subsidizing for producers that supply the goods and services we get. So when we are able to understand the arrangement between what we pay and what government is giving to us, we get to know our basic price adjustments. So GVA has two formulas. It's either you say GDP minus indirect taxes for subsidies, or GDP minus basic price adjustment. I think it's clear. Is that clear, please? Mm-hmm. So for basic price adjustment, the meaning is this. This requires taxpayers to compare two cash flows, that's the money they receive and which they paid, under an arrangement against, when we talk about arrangement, we're talking about what government is doing, against the income received at the same arrangement. So government is charging indirect taxes, and at the same time government is giving subsidies. So we will be able to know the difference in both arrangements. Do we get it? It is the government of Libya. Government of Libya is imposing taxes. Government of Libya is subsidizing for goods. So we get to know the difference, the balancing between them. That is basic price adjustment. I think it's clear that way. Then we'll go to the GNI, gross national income. For gross national income, I wrote, it measures the domestic output of the country plus the earnings from overseas. So, like the question you asked me the other time about how do I send money home, or how will government of the country knows what I do? This is it. We said